Welcome back, Smart Stock Sam fam. Stop scrolling for 1 second because what I'm about to show you could be either the single greatest asymmetric trade on the board right now or the most catastrophically leveraged time bomb in the entire history of cryptocurrency. And yes, I know that sounds like an exaggeration. It is not. The smart money, the institutional players, the whales, the quantitative hedge funds, they are quietly, systematically buying the wreckage of one specific stock while retail investors panic, sell it into the dirt. Do they know something the rest of us do not? Or are they walking straight into a trap? Today on Smart Stock Sam, we are doing a full forensic teardown of BitMine Immersion Technologies, ticker symbol BMNR, a $9.6 billion asset base, a Treasury strategy so aggressive it has cornered nearly 5% of the entire global supply of Ethereum, and a leverage structure so fragile that if it cracks, it does not just wipe out shareholders. It could trigger the largest crypto market collapse in recorded history. The full picture, the upside, the downside, the hidden metrics, the death spiral risks, and exactly what the math says about where this stock goes from here. If you have been asking why smart money is buying this crash, you are about to find out. Let us get into it. Before we look at the balance sheet, let us quickly establish what BitMine actually is, because this is not your average crypto mining company. They have completely abandoned legacy Bitcoin mining. Instead, they have transformed themselves into the world's largest corporate Ethereum treasury. They now hold 5.54 million ETH. To put that into real-world context, that is 4.59% of the total global circulating supply of Ethereum, controlled by one single publicly traded company. Think about that for a moment. Does that concentration level worry you? It absolutely should. But it should also get you thinking about what happens to the price of Ethereum if this company's strategy works perfectly. Now, building a treasury this large does not come cheap. They have been using preferred equity offerings to aggressively accumulate this ETH, and their average cost basis sits at roughly $3,526 per token. Given where ETH is trading right now, that means they are carrying somewhere between $9.6 billion and $10.1 billion in unrealized paper losses. That number, on its own, would have already bankrupted most companies on the planet. But here is what separates BitMine from every other digital asset treasury out there. And this is the piece that most retail investors are completely missing. They are not just sitting on these tokens in cold storage, praying the price recovers. They are actively putting their Ethereum to work. By staking over 85% of their total holdings, they are generating a 2.99% annualized yield, a yield that currently translates to $230 million in hard, recurring annual revenue. This is the fundamental thesis. This is why smart money is paying attention. This company is not just a passive crypto bet. It is a yield-generating machine built on a digital asset treasury. So let us deconstruct that $9.6 billion balance sheet, because the composition tells you a lot about management's thinking. The obvious centerpiece is the 5.54 million Ethereum. That is the entire engine. They also hold 204 Bitcoin as a legacy treasury position, but at this scale, that is essentially a rounding error. What is absolutely critical is their $247 million in cash. In a highly volatile, heavily leveraged operation like this, cash is not just a number on a spreadsheet. It is oxygen. It is the only thing standing between a temporary drawdown and a forced liquidation. But here's where it gets really interesting. Management is not just hoarding crypto and cash. They are using this balance sheet to make venture capital-style bets on the next generation of the digital economy. They hold a $180 million stake in Beast Industries. That is direct exposure to the Mr. Beast creator economy ecosystem. And they hold an $88 million stake in 8Co Holdings, ticker symbol ORBS, which gives them indirect exposure to OpenAI. They are essentially building a hybrid treasury that sits at the intersection of crypto, the creator economy, and artificial intelligence. Whether that is visionary or reckless depends entirely on how their core ETH strategy performs. Now, a question I know you are already asking: why Ethereum? Why not just do what MicroStrategy does and stack Bitcoin? The answer is one of the most important distinctions in all of digital asset investing right now. Active yield versus passive capital appreciation. MicroStrategy's entire model is built on using capital markets to buy Bitcoin for absolute scarcity. It is completely passive. The only way that model works is if Bitcoin's price goes up. If the market trades sideways for 2 or 3 years, they still have to service their debt obligations with zero income coming in the door. BitMine made a deliberate, strategic choice to hold Ethereum specifically because it is a productive asset. It generates yield. By deploying 85% of their treasury into staking, they create a compounding revenue stream that exists independently of short-term price movements. For BitMine, if the market trades sideways on any given Tuesday, the staking yield is still running. It is still generating cash. It is still servicing their obligations. That structural distinction is enormous, and it is why the institutional community has a fundamentally different view of BMNR than the retail crowd right now. The internal engine behind this strategy is what the company calls the Alchemy of 5%. Let me walk you through exactly how it works, because the mechanics are genuinely elegant. Step 1. BMNR raises capital through equity and preferred stock offerings. Step 2. They deploy that capital to accumulate Ethereum at what they believe are multi-year lows. Step 3. This is where the magic happens. They take 85% of that treasury, approximately 4.71 million ETH, and feed it into their proprietary Made in America validator network, which they call Maven. That staking engine runs at a 2.99% annualized yield, generating between $230 million and $270 million in hard annual revenue. Step 4. That yield directly services their 9.5% preferred stock dividends. If the loop holds, they never need to sell a single ETH to cover carry costs. The assets stay intact. The yield covers the obligations. The treasury compounds. It is elegant financial engineering when it works. But here is the brutal reality that no one who is bullish on this stock can afford to ignore. The market structure right now is not cooperating. We are in the middle of a 65% drawdown in the price of Ethereum. Since its peak of $4,946 in August of 2025, ETH has been absolutely crushed, plummeting to a 52-week low of just $1,505. And this is not just normal crypto volatility. The sell pressure is being driven by a convergence of systemic forces. In May of 2026 alone, U.S. spot Ethereum ETFs recorded $540 million in net outflows, followed by another $130 million in early June. The structural buyers are leaving the market, not entering it. Add to that sticky inflation, with CPI hitting a 3-year high of 4.2%. Add escalating geopolitical risk from the U.S.-Iran conflict. Capital is rotating violently out of risk assets and into defensive commodities and safe havens. The macro environment could hardly be worse for a company like BitMine, and yet, and this is the paradox that is driving institutional investors absolutely crazy, the smart money is not selling. They are buying. We are witnessing a textbook valuation disconnect playing out in real time. On one side, you have complete retail capitulation. BMNR's stock has shed over 50% from its highs and is now trading in the $15 to $16 range. Social media sentiment is overwhelmingly bearish. Retail traders are frustrated, comparing BMNR's performance to meme coins and AI tokens, demanding momentum they are simply not getting. But flip to the options market and you see a completely different movie. We are seeing between 106,000 and 131,000 options contracts traded every single day, and a full 70% of those are call options. The smart money is not just holding, they are actively positioning for a massive upside move. Research firms are calling this the free call option thesis. Historically, investors have paid a $4.6 billion premium over BMNR's net asset value. Today, because the stock has been crushed by retail panic, buying shares at $15 is like getting an unpriced free call option on a full Ethereum macro recovery, but only if that recovery actually comes. And here is where the on-chain data gets extraordinarily interesting. Ethereum's Daily Relative Strength Index, the RSI, has just hit its lowest level in recorded history. Let that genuinely sink in. In all the years of Ethereum's existence, price has never been this oversold on a technical basis. Furthermore, Ethereum has officially fallen below the 0.8 MVRV pricing band. MVRV stands for market value to realized value. When it drops below 0.8, it means the majority of market participants are holding ETH at a loss. Historically, not always, but historically, this specific zone aligns almost perfectly with long-term accumulation zones and macro cycle bottoms. The last few times these two signals converged, they preceded enormous multi-year recoveries. Could this time be different? Of course, but the math is flashing a signal that serious investors cannot dismiss. And layered on top of the on-chain signals, there is an invisible supply dynamic building beneath the surface. While ETFs and retail traders are flooding the market with sell orders, over 475,000 ETH has quietly been drained from exchange reserves. It is being pulled off the market by whales and corporate treasuries, led primarily by BitMine, who are buying the panic and immediately moving the supply off exchanges to stake it. This removes liquid inventory from the market entirely. When macro conditions stabilize and demand eventually returns, the available supply simply will not be there to absorb it. That is the blueprint for a violent supply shock. Could the demand side take years to return? Absolutely. But when it does, the math gets very aggressive very quickly. Now, investors need to keep their eyes on a specific radar of catalysts that could accelerate or derail this thesis in the near term. On the risk side, there is an AI-discovered vulnerability in Zcash that is causing sector-wide panic selling. There is the historic $1.75 trillion SpaceX IPO, which is draining enormous liquidity from risk markets as funds raise cash to participate. And critically, MicroStrategy recently sold 32 Bitcoin to fund dividend payments, a move that has shattered the so-called never-sell thesis and triggered broader crypto liquidations. These are not trivial headwinds. But on the structural catalyst side, watch two things very closely. First, the Clarity Act, a crucial regulatory safe harbor bill for digital assets. Its probability of passing has slipped below 60%, but any positive movement sends this entire sector flying. Second, and potentially more immediately impactful, BitMine is facing impending inclusion in the Russell 1000 index in late June. Index inclusion means automated, passive institutional inflows. It does not matter what retail sentiment says. When a stock enters the Russell 1000, the passive funds are required to buy. That is a structural liquidity injection that is coming regardless of where Ethereum is trading at the time. But none of this changes the central structural vulnerability that has to be front of mind for every single investor in this name. BitMine is built on heavy leverage, and leverage is completely indifferent to your investment thesis. The company recently upsized a $274 million offering of 9.5% Series A perpetual preferred stock. That 9.5% cumulative weekly dividend is not a guideline. It is a rigid, contractual obligation. In a stable environment, the $230 million staking yield covers it comfortably. But if Ethereum prices remain severely depressed, the dollar value of that yield drops, and the margin between income and obligation shrinks fast. Compound that with a deeply counterintuitive gap accounting quirk. Because of fair market value accounting rules, BitMine has to report their ETH holdings at current market prices on every single quarterly earnings report. That means they are showing roughly $10 billion in unrealized paper losses on their financials. To a traditional institutional investor who is not deeply familiar with crypto treasury mechanics, That earnings report looks like a catastrophic balance sheet implosion. It triggers panic selling from people who genuinely do not understand what they are looking at. And that artificially suppressed stock price is exactly what creates the asymmetric opportunity, but also what creates the systemic fragility. Because here is the nightmare scenario, and I want you to really sit with the mechanics of this. If Ethereum breaks below $1,500 and the structural support fails, the dollar value of BMNR's staking yield collapses. Their operational cash flow could drop below the level required to service those 9.5% preferred dividends. With no cash buffer left, they face an unthinkable choice: liquidate their 5.5 million ETH Treasury to meet their obligations. Dumping that volume of supply onto an already fragile, illiquid market would cause a historic crash in Ethereum's price. That crash would further destroy BMNR's yield, forcing more liquidations, a death spiral. Major market makers have explicitly warned that BMNR's extreme concentration means a forced liquidation event would not just bankrupt this company. It would trigger systemic contagion across the entire digital asset industry. That is the risk you are accepting when you buy this stock. Full stop. So what does all of this actually mean for valuation? We can map 3 clean scenarios. The bull case: Ethereum reclaims $2,500 or better. The MVRV and RSI signals prove accurate. The Treasury NAV skyrockets, driving massive stock appreciation. The Maven yield comfortably covers all dividend obligations. Russell 1000 inclusion brings passive institutional inflows. BMNR functions as a 10 to 16 times leveraged proxy on Ethereum's recovery, and investors who bought at $15 and $16 are sitting on extraordinary gains. The base case, ETH, consolidates in the $1,600 to $2,000 range. Macro headwinds persist. BMNR relies almost entirely on its $230 million staking revenue just to survive the consolidation. The stock trades sideways with brutal volatility, but crucially avoids forced asset sales. Investors grind it out. The bear case, ETH, breaks below $1,000. $1,500 support fails. The staking yield collapses in dollar terms. The death spiral activates. Forced liquidation events trigger historic market contagion. This is not just a bad trade. This is a potential sector-defining catastrophe. At the current entry point of $15 to $16 per share, BMNR represents the definition of an asymmetric setup. The leverage is working both ways simultaneously. It is a massive multiplier on the upside and a potential extinction event on the downside. The $1,500 floor on Ethereum is not just an important level. It is the single most consequential number in this entire thesis. Above that floor, the leverage amplifies every dollar of Ethereum recovery into enormous stock gains. Below that floor, the whole structure starts to fold. Before I give you my final take, I want to be completely transparent with you. I am not your financial advisor. Nothing in this video is financial advice. Everything presented here is for educational and informational purposes only. Investing in leveraged digital asset vehicles like BMNR carries extreme risk. You could lose your entire investment. Always do your own due diligence, consult a licensed financial professional, and never invest money you cannot afford to lose entirely. The scenarios I have described are possibilities, not guarantees. Cryptocurrency markets are volatile, unregulated, and can behave in ways that defy even the most rigorous analysis. With that said, here is my honest conclusion. Smart stock. Sam is rating BMNR as a speculative buy for highly risk-tolerant investors with a disciplined position sizing strategy and a hard hold for anyone with a conservative or low volatility mandate. The opportunity is real. The on-chain data is genuinely compelling. The Russell 1000 inclusion is a structural catalyst that cannot be argued away. And the free call option thesis at $15 to $16 makes mathematical sense in a recovery scenario. But this is strictly, unambiguously speculative. If you are taking a position, you must set a hard stop loss tied to the $1,500 Ethereum support level. You must size your position for the possibility of a complete wipeout, and you need to watch that late June index inclusion date like a hawk. Now I want to hear from you. Drop your answer in the comments right now. If BitMine were forced to liquidate even 10% of their ETH holdings tomorrow, do you think the market structure could absorb it, or would we see a cascade? That is a real question with a real answer buried in the on-chain data, and I want to know what you think. While you are down there in the comments, hit the like button if this deep dive gave you a sharper edge on BMNR. It genuinely helps this channel reach more investors who need this kind of analysis. And if you are not subscribed yet, what are you waiting for? Hit that subscribe button right now so you never miss a teardown like this one. If this video added real value to your investing process, consider sending a super thanks using YouTube's support feature. It goes directly to keeping this channel running and independent. And finally, if you want to go even deeper, get access to early analysis, exclusive watch lists, and a community of serious investors working through these exact setups together, the Smart Stock SAM membership is live. Join the community, level up your investing game, and let us navigate these markets together. I will see you in the next one.